What if a lender cared less about your personal income and more about whether the rental property could pay for itself? That is the basic idea behind a DSCR loan. A lot of beginner real estate investors hear about DSCR loans and think, this sounds like an easy way to buy rental properties. But here is the truth. DSCR loans can be powerful, but they can also be risky if you do not understand the numbers. In this video, I'm going to explain what a DSCR loan is, how lenders look at it, what numbers matter, and the mistakes investors need to avoid before using one. Welcome to Money, Credit, and AMP, Real Estate, where we break down money, credit, lending, and real estate investing in a simple, practical way. Today we are talking about one of the most searched real estate financing topics for investors, DSCR loans. Let's start with a basic question. DSCR stands for Debt Service Coverage Ratio. That sounds complicated, but the idea is simple. A DSCR loan is usually used for investment properties, and the lender focuses heavily on whether the property's income can cover the property's debt payment. In other words, the lender is asking, does this rental property make enough income to pay the mortgage? DSCR is commonly calculated by dividing net operating income by debt service, meaning the property's income compared to its required loan payments. Chase and Investopedia both describe DSCR as a way to measure whether income can cover debt obligations, including principal and interest. So if a property has enough income to cover the loan payment, the DSCR is stronger. If the property does not make enough income to cover the loan payment, the DSCR is weaker. That is why DSCR matters so much in rental property lending. Here is the simple version. DSCR equals property income, debt payment. Let's use easy numbers. Say a rental property brings in $2,000 per month in rent, and the loan payment is $1,600 per month. You divide $1,600 equals 1.25. That means the property brings in 1.25 times the debt payment. Put another way, the rent is 25% higher than the loan payment. Now let's say the rent is $1,500, but the loan payment is $1,600. That would be $1,500. $1,600 equals 0.94. That means the property does not cover the debt payment based on those numbers. That is a red flag. Different lenders have different rules, but the basic concept is the same. The higher the DSCR, the more comfortable the lender may be. The lower the DSCR, the riskier the loan may look. So why do real estate investors like DSCR loans? The biggest reason is that DSCR loans may rely more on the property's income and less on your personal income. That can matter for people who are self-employed, own businesses, take deductions, or do not show high W-2 income. Traditional loans often look closely at your debt-to-income ratio, tax returns, job history, and personal income. DSCR loans are different because the lender is mainly asking, can the property support the loan? That can make DSCR loans attractive for rental property investors who want to scale. For example, someone may already own several rentals. Their personal tax return may not show a huge income because of depreciation, deductions, or business expenses. A DSCR loan may allow the investor to qualify based more on the property itself. That is why people often call DSCR loans investor loans, or rental property cash flow loans. But this does not mean lenders ignore everything else. This is where beginners sometimes misunderstand DSCR loans. They hear, no personal income required, and think that means the loan is easy. Not exactly. Even if the lender focuses on the property's income, they may still care about your credit score, your down payment, your cash reserves, the property type, the rent estimate, the appraisal, the condition of the property, your experience as an investor, the location, the loan-to-value ratio. A DSCR loan is not free money. It is still a loan. And the lender still wants to reduce risk. In many cases, investors may need a larger down payment compared to a primary residence loan. Interest rates may also be higher than a typical owner-occupied mortgage. Why? Because investment property loans are riskier for lenders. If someone gets into financial trouble, they are usually more likely to protect the house they live in before protecting an investment property. So yes, DSCR loans can be flexible, but they are not magic. Now let's talk about the biggest risk. The biggest risk with DSCR loans is using numbers that are too optimistic. This is especially important in today's market. A property might look good on paper if you assume high rent, low expenses, no vacancy, and no repairs. But real estate does not work that way. You have to ask, what if rent is lower than expected? What if the tenant leaves? What if taxes go up? What if insurance increases? What if repairs are higher than expected? What if interest rates make the payment too high? If your numbers are too optimistic, the deal can fail even if the loan gets approved. This has become a bigger issue recently. Business Insider reported that DSCR loans became popular with smaller landlords, but rising interest rates, inflation, and slower rent growth have exposed problems for some over-leveraged investors. That is why I do not want you to think of a DSCR loan as a shortcut. It is a tool, and any tool can hurt you if you use it the wrong way. Section 6. Example deal breakdown. 710-835. Let's walk through a simple example. Imagine you are looking at a small rental property. The expected rent is $2,200 per month. The loan payment, including principal and interest, is $1,500 per month. At first glance, that seems good. $2,200. $100 is 1.447. That looks like a strong DSCR. But wait, we also need to think like an investor. What about taxes? What about insurance? What about repairs? What about vacancy? What about property management? If the lender is only comparing rent to debt payment, the loan may look easier to approve. But as the investor, you need to look deeper. Let's say after realistic expenses, the property only produces $1,650 per month before debt. Now the calculation is $1,650. $1,500. $1,010. That is much tighter. And if the property has one bad repair or 1 month of vacancy, your cash flow could disappear. This is why you should not just ask, "Can I get the loan?" You should ask, "Should I buy the deal?" Those are two very different questions. A DSCR loan may make sense for certain investors. It may be useful for self-employed borrowers, real estate investors with multiple properties, business owners, investors whose tax returns do not show high personal income, people buying income-producing rental property, investors who understand cash flow and risk, but it may not be right for everyone. If you are a brand new investor, you need to be extra careful. Not because beginners cannot use DSCR loans, but because beginners may not yet understand expenses, repairs, vacancy, tenant risk, and financing risk. The loan is only one part of the deal. The property still has to make sense. Section 8. Mistakes to avoid. 925 to 1035. Here are the biggest DSCR loan mistakes to avoid. Mistake number 1. Only looking at rent and mortgage payment. You need to understand the full expense picture. Mistake number 2. Assuming the highest possible rent. Use realistic rent numbers, not fantasy numbers. Mistake number 3. Ignoring vacancy. Even good properties can sit empty between tenants. Mistake number 4. Forgetting repairs and maintenance. Every property eventually needs money. Mistake number 5. Thinking loan approval means the deal is good. A lender approving the loan does not automatically mean you are buying a smart investment. Mistake number 6. Over-leveraging. Just because you can borrow does not mean you should borrow too much. Good investors protect cash flow. So here is the main lesson. A DSCR loan can be a powerful tool for rental property investors because it focuses on whether the property can support the debt. But it is not a shortcut around good investing. You still need to understand the rent, expenses, loan payment, cash flow, repairs, vacancy, credit requirements, and risk. Remember this, the goal is not just to get approved. The goal is to buy a property that actually makes financial sense. If this video helped you, subscribe to Money, Credit, and AMP, Real Estate for simple lessons on money, credit, lending, and real estate investing. In the next video, we'll break down the exact numbers you should check before buying your first rental property.